Hi everyone, I'm Debbie Roberts, owner and financial advisor at Property Apprentice. Join us today for the Week in Review, where I'll talk about current events for the everyday investor and home buyer. Our topics for this week: first up, from the Mortgage Mag on the 28th of March, the refinancing wave, the good, bad and ugly. Second topic, from Stuff on the 27th of March, why landlording is the business that's not treated as a business. Third topic, Stuff on the 29th of March, what happens when housing's wealth effect dries up. Fourth topic, from interest.co.nz, 30th of March, construction industry looks headed for a major slowdown as the number of new consents dives. And fifth topic for this week in review, from Newshub on the 29th of March, no signs of weakening job numbers despite looming recession, from Infometrics. So first up this week, from the Mortgage Mag on the 28th of March, the refinancing wave, the good, bad and ugly. This is an analysis provided by CoreLogic chief economist Calvin Davidson on the top 5 issues facing borrowers. Number 1, the refinancing wave remains significant in 2023. Around 50% of existing loans by value are fixed but are due to be repriced in the next 12 months, while another 10% are floating. This means that around 60% will be repriced at higher interest rates. Many households will need to adjust their budgets, and movement in the housing market will be slower for longer. Number 2, mortgage rate increases could be substantial. CoreLogic has no data on when borrowers initially took out their loans, which means that they can't determine what the starting interest rates were. However, it is reasonable to assume that a lot of borrowers have been enrolling one-year fixes, with the change that many will see as they reprice in the range of 2 to 3%. One example is when somebody's repricing from 4% going up to 6.5%. The increase in mortgage repayments on a $500,000 30-year mortgage then would be an increase of about $9,275 a year. Number 3, mortgaged households are showing resilience. While financial challenges are likely to come in the next few months, the repricing process to date has been smooth. The level of loan repayment problems and non-performing debt on bank books remains low. However, it is still important to note that Centrix data shows more borrowers are missing payments. Number 4, minimal job cuts will be a helpful buffer. The unemployment rate is expected to rise, but the Reserve Bank's projection isn't about mass job losses. It's more about people struggling to find jobs as hiring slow down. Those who are currently employed and have a mortgage should be able to deal with higher repayments. On the other hand, newcomers to the labour market might find it challenging to buy a home. Another positive piece of information from the Reserve Bank is that interest-only lending remains controlled. A shift by some borrowers onto interest-only terms could also be a temporary buffer at this time. Number 5, pay attention but don't panic. The repricing process will be watched closely for any signs of bad debt. This could potentially lead to mortgagee sales, although even this is a last resort. Davidson expects mortgage repricing to be a lesser issue, as most repricing events will be from high mortgage rates to higher instead of low mortgage rates to higher. So my tips would be, if you're coming off a fixed rate and you're worried about the impact on that, get advice from a mortgage advisor, and instead of dealing directly with your bank, because there could be some other options available to you, and a mortgage advisor can help you through that process. So if you don't have a mortgage advisor already, I highly recommend that you get in touch with Jean Andrews at MITeam. That's MITeam.co.nz. So you can contact Jean via the website or email Jean, that's GENE, at MITeam.co.nz. Second topic, from Stuff on the 27th of March, why landlording is the business that's not treated as a business. There's an ongoing debate about whether private landlords who rent out homes qualify as a business based on the definition that those providing services and making a profit are classified as a business. The Ministry of Business, Innovation and Employment, or MB, website states that collecting rent on a home, whether it's a deliberate investment or an accidental acquisition, is considered running a business. However, landlords believe that they're not treated fairly like other businesses. They're subject to more rules and regulations. A counter-argument is that housing is a human right. Therefore, landlords are responsible for providing a decent home, which is different compared to other types of businesses. Staff asked experts to present their arguments on why landlording is treated differently and whether it should be. Property Investors Federation Vice President Peter Lewis said rental accommodation is classified, controlled, and treated as a business by Inland Revenue, MB, and WorkSafe. Even if landlords have the legal obligations of running a business, many people still question whether providing residential rental accommodation is a business. The only difference between motels or hotels, which are businesses, and landlords renting out properties is the duration in which the property is being rented out. There are no qualms about treating motels or hotels that rent out rooms by the night or week as a business, but there seems to be issues when landlords rent out their properties. Residential rental services are treated differently than any other businesses. A good example is the elimination of interest deductibility on rental income, while other businesses can still deduct interest on any loans that they have. Rents have risen as landlords try to recoup the costs and for their businesses to make a profit. Lewis thinks it's okay to earn money from providing a service that people want. Part of the tax that landlords pay goes to fund the social welfare state. He added that if there's a right to housing, someone has to supply it. Either the state creates more homes or private landlords do, who are generally more efficient and they can earn money from it. And in New Zealand, approximately 85% of all tenants rent from a private landlord or trust. So, landlords do make up the majority of the rental property providers in New Zealand. Infometrics Chief Executive Brad Olson said that based on pure economic principles, landlords should be able to deduct interest from their rental income. All the other rules of business should also apply to landlords. Just as businesses have fair trading rules and consumer guarantee protections, landlords need to keep a high quality of service. The healthy home standards are necessary and are not a burden as some claim it to be. Tax expert Terry Bosher from Bosher Consulting believes that it's incorrect that no other business is denied interest deductibility. New Zealand companies with foreign parent companies have a 60% safe harbour threshold. If this is exceeded, there's no interest deduction. Their existence shows that there are similar rules for other businesses. My personal opinion on that is that's a bit of a stretch. We're talking about New Zealand landlords here, especially since, foreign buyers aren't allowed to buy rental properties in New Zealand anymore. Bosher also points out expectations around returns as a major question for landlording as a business. He thinks that even if the cash returns on property investment are generally low, it's the expected increase in capital gains that drives it. Large investors with 10 or more properties who operate at scale will generate sufficient returns to provide a living income. However, if a landlord borrows $1 million with a 2% return, that's not a living wage. He believes it's fair that mum and dad investors with 1 or 2 properties are looking for a different type of gain and are investing for the future. But he argues that it's not an ideal business model where people earn income and produce a return on equity above what is borrowed. That means landlords can't claim that they're treated unfairly. Osher said that the interest deductibility policy is ad hoc and due to New Zealand's failure to tax capital properly. So I would suggest that there's a lot of landlords who buy property which is negative cash flow to begin with, but their intention is to pay the mortgages down over, however many decades they've got left before they reach retirement. And we generally do expect rental income to increase over time as well. So, it's looking for the passive income for retirement. And some people do make a decision to downsize their portfolio ready for retirement as well. But I certainly disagree with some of the things that Bosher said. That's my personal opinion, and I'm entitled to it, just like he is. Human Rights Commission Housing Inquiry Manager V. Blackwood says that mum and dad landlords may invest in residential property to save for the future, but earning money from renting to tenants is a business activity that should be treated as such. Blackwood believes that all businesses have human rights responsibilities, and some have more responsibilities due to the nature of service or the product they provide. The right to a decent home is a fundamental human right guaranteed by international human rights laws that successive governments have signed up to. It has 7 components, including security of tenure, affordability, and habitability. And I couldn't agree more. Blackwood stated that some landlords are great and adhere to the tenancy law, while others don't understand their duties. She thinks more needs to be done so landlords are aware of their obligations and deliver on them. She suggested regulating landlords or maintaining a record of compliant landlords under the Healthy Homes system. Look, and my personal opinion on that is I don't hate that idea. The government is certainly looking at regulating property managers. So my personal opinion is that I think that there should also be a requirement for private landlords to go through some sort of training or regulation just to make sure that they're aware of their obligations. The New Zealand Property Investors Federation has got a great online training program for people who want to manage their own rental properties. So I highly recommend that for anyone who's currently managing their own rentals. If you'd like to learn more about investing in property, join me at one of our free events called How to Succeed with Property Investing in 2023. I'll discuss strategies for successful investing from my perspective as a financial advisor, available live online or in person. Check out propertyapprentice.co.nz for upcoming dates and register today. We don't sell property, so it's all about increasing your knowledge to reduce your risk. If you'd like to find more about how we can help you to reach your financial goals, you can either attend one of our free events, because I also talk about this towards the end of the session, or you can book a no obligation phone call or meeting with my husband, Paul Roberts, via the website also. That's propertyapprentice.co.nz. Third topic for this week in review from Stuff on the 29th of March. What happens when housing's wealth effect dries up? For years, it's been easy for homeowners to feel wealthy while watching house prices rise. As a result, they go out and spend. That spending has occasionally been backed by home loan top-ups made possible by the increase in homeowners' equity. Although, to be fair, you still also have to provide provable income to enable you to increase your loans. Sometimes people simply feel more confident in taking out additional loans. A few economists consider this wealth effect to be beneficial to the economy since more spending stimulates it. However, capital gains are only on paper until the home is sold, whereas debts incurred through the wealth effect spending are real and must be serviced with regular repayments. Centrix data shows around 430,000 Kiwis were behind on their bills in February. Loan arrears have hit a 3-year high. In the same month, 18,400 were late on their home loans. Another insight is provided by Centrix data, which shows that as house prices rose, Kiwis took on larger consumer loans and more credit card debt. The level of correlation, according to Centrix General Manager of Analytics, Stuart Baxter, was surprising, but the trend wasn't, especially given that inflation would increase the size of loans. To some degree, he said the correlation suggested the wealth effect was at play due to the boost in consumer confidence caused by rising house prices. There was evidence Kiwis were turning more to personal loans as they struggled with the cost of living, so the trend of larger loan sizes may continue even as house prices fell, creating a new divergence of the metrics. Centrix Managing Director Keith McLaughlin believes it's more helpful to think of the country as having two distinct economies. The first is those who've owned their homes for a while and mainly bought pre-pandemic. Their homes are still worth far more than the price they paid for them, and they will have paid down more of their mortgages. He thinks this group will probably continue to spend. The second group is composed of recent buyers who bought at the peak of the market and whose house values may have fallen by up to 16%. This group is likely to cut back on spending and will feel a kind of poverty effect. Although house prices have been steadily declining for over a year, the amount borrowed for new vehicles increased in 2022 but fell in 2023. Baxter explained that the size of vehicle loans would have been boosted by the general increase in the cost of second-hand vehicles, which was largely due to a lack of supply. Martin Hawes, a financial author, believed that the wealth effect was backfiring and that it was only being offset by extremely low unemployment. He also believes that because a lot of stress testing has been done on borrowers, he didn't predict any catastrophic effects for those who spent as their house prices rose. Infometrics chief forecaster Gareth Kennan described himself as one of the biggest skeptics of the wealth effect. For him, while house price rises might attract some of the more daring to go out and spend, most realised that they'd be buying in the same market when they came to sell and would act cautiously. The correlation between borrowing and house prices was most likely caused by other factors. He claimed that previous housing booms occurred during periods of low interest rates, strong labour markets, and strong income growth, all of which encouraged people to spend on other things. With fixed home loan interest rates sitting at around 6.5%, it was not shocking if spending in all other areas dropped. Keenan stated that a slight slowdown in vehicle purchases was consistent with other spending indicators that he'd observed, such as appliances and furniture. Economist Tony Alexander agreed with Keenan that the wealth effect was small. Alexander assigns greater importance to income and expectations of future employment as an indicator of consumer spending rather than changes in asset values. Fourth topic for this week in review from interest.co.nz on the 30th of March. Construction industry looks headed for a major slowdown as the number of new consents dives. The number of new dwellings consented in February was down 29% compared to February last year. This is the fifth month in a row that the number of new homes consented has been below the same month of the previous year, which signals an end to the 11-year run of increasing residential construction activity. In the 12 months to February, 48,257 new dwellings were consented. This is 3.3% below the previous 12 months. The decline may have been small, but this is the first time the number of new homes consented has fallen on an annual basis since 2012. During the same period, however, the number of new homes consented annually increased by 342%, resulting in a building boom that has transformed the construction industry into one of the economy's key industries. The slowdown in construction activity late this year and early next year now seems to be inevitable. The fall in February consents compared to a year ago was seen among the main housing types of standalone houses, which were down by 33.2%, apartments, which are down by 19.3%, and townhouses or home units, which were down by 36.9%. Retirement village units were the only sector to show growth, with consents up by 78.9% in February compared to a year earlier. Non-residential construction's also weakening, with the total of non-residential buildings down by 9% in the 12 months to February compared to the previous 12 months. And look, all of this is perfectly normal for this stage of the property cycle. So, certainly no surprises there. Fifth topic for this week in review on Newshub, this on the 29th of March, no signs of weakening job numbers despite looming recession, according to Infometrics. Infometrics data shows that job numbers continue to rise as employment levels climb despite an imminent recession. Statistics New Zealand's monthly employment indicators showed that filled jobs rose again in February. This is up 0.4% from the previous month, seasonally adjusted. At a regional level, a drop in job growth can be observed in areas affected by Cyclone Gabriel. Gisborne was 1.8% lower than a year ago. Employment growth in Hawke's Bay slowed from 1.2% a year in January 2023 to 0.7% a year in February. On the other hand, employment in February rose in Auckland by 2.6%, rose in Wellington by 1.9%, and in Canterbury by 3.4%. In a statement, Infometrics stated that despite the labour market being the last part of the economy to turn, the fact that job growth is still strong indicates that pressures still face the economy. The Reserve Bank in New Zealand and the Treasury have both agreed that New Zealand will enter a technical recession this year, with the latter forecasting a 0.8% contraction across 3 quarters. Services employment increased across the board, with notable increases in tourism-related industries such as accommodation and food services, which increased by 8.5%, arts and recreation services, which increased by 6.6%, and transportation, which increased by 6.2% compared to the same month in 2022. Other areas have seen significant job growth as well, with a 2.9% increase in professional services and a 4.2% increase in administrative and support services filled jobs. Property Apprentice's free events cater to the changing needs of first home buyers and investors all across New Zealand. Join me for our upcoming event, how to succeed with property investing in 2023, with my tips as a financial advisor regarding strategies for successful investing. They're live training sessions held either online or in our Auckland office. There's plenty of opportunity to ask me questions. I'll answer as many of them as possible. You can register on our website at propertyapprentice.co.nz and check out the details there. And if you'd like to have a no obligation chat with my husband Paul to see how we could help you, you can also book a meeting or phone call with him via our website. That's propertyapprentice.co.nz.